If you're one of those investors watching CNBC, Fox Business News, or Bloomberg TV all day, 5 days a week, most likely worrying about stock market volatility is high on the list of your concerns. Many of our most vocal clients and prospects tend to contact us more often when they feel higher volatility in the markets or hear about it on the news channels. In this episode, we'll discuss stock market volatility and the difference between what investors may be feeling emotionally and what's actually happening in the markets. When talk of volatility broadcasts on the TV news networks, I like to go back to a quote from the movie Princess Bride. What is that? That's inconceivable, as Inigo Montagu used to say.
Inconceivable! You keep using the word. I don't think it means what you think it means.
I find that most TV commentators use the words volatility in this way. Before we continue with this week's topic, volatility, yes, it's been collapsing in its normal cyclical way, inconceivable to many. Please take a moment to click on the subscribe button and click on the notification bell, so you'll be alerted when our team uploads our latest content. We do have a new location for our Oak Harvest investment-oriented content. You can find it by typing Stock Talk with Chris in the Google search window, or going to the Oak Harvest YouTube channel and clicking on the drop-down tab labeled Channels and clicking on Stock Talk with Chris. In previous videos, we've discussed many ways to measure stock market volatility, or many indexes that track market volatility. We've discussed the difference between realized volatility and implied volatility in the past. Measures of implied volatility discussed previously include the MOVE Index, a Bank America index that measures Treasury bond market volatility. We like to follow this index to measure stress in the collateral markets. Why? Because it's the safest and most liquid collateral in the world. U.S. Treasuries are trending higher. It forces leveraged players to sell assets, whether they want to or not. We've discussed the Spot VIX Index many times over the last few years in our educational videos. This calculation is widely quoted on TV as a measure of stock market volatility. However, viewers remember that it's a calculation only. It's a calculation of implied stock volatility. It is not, I repeat, it's not a tradable index. It's not realized volatility. While it's one of the most widely recognized measures of stock market volatility, it's not tradable. It's not predictive of future stock market moves. It's a calculation derived from quoted prices on S&P 500 index options, both puts and calls. It isn't even calculated based on actual real-time trading data. It's the average of the bid or ask quotes, whether securities trade at those levels or not. It's math. It's not real trading. Investors recently, due to the increased popularity among retail investors in trading 1 to 0 day options around news events, the marketing geniuses at the Chicago Board of Options Exchange launched a 1-day CBOE volatility index. It's the VIX 1D index. I won't get into how it's calculated, but suffice it to say, the team at Oak Harvest recommends that no one speculate in these types of instruments. So what's someone who's watching the financial news network supposed to do when most of the financial commentators on TV start talking about high market volatility? What are they supposed to do? Ignore it. Turn off your TV. Why do I say this? Because most of the data these financial experts tout is not predictive or useful in determining market volatility or the direction of future stock prices. How can it be predictive when it's not even using actual trades? It's just using the average of quotes. Investors, as much as the TV financial hosts want to talk about market volatility being high, they're wrong. They're making things up. Take a look at the weekly chart of the 2-month forward volatility futures contract. This is actually tradable in the real markets. This is what market participants really think and put their money at risk about the direction and level of future volatility. As one can see, throughout the middle of 2022, the forward volatility never exceeded 32.5 for virtually any period of time. It stayed above that level for hours at most. Every time it got to that level in price, market participants came in and bought back their volatility hedges, culminating in a final peak at around 32 in mid-October of 2022, just as the S&P 500 bottomed out the week of October 14th. Take a look at the chart of the S&P 500. No, I'm not a chartered financial technician, but I can't find an example of this pattern for the last 20 years that wasn't bullish. Once again, my magic number for the cash S&P 500 is a monthly close above 41.25 to 41.30 and a monthly close on the NASDAQ composite cash above 12,100. Take a look at the shorter term daily chart of the 2-month volatility future. This daily chart of forward implied volatility is down and to the right in a stair-step fashion. This is historically bullish for equities, as lower trending volatility has historically correlated with rising stock prices as investors feel more comfortable taking on risk as the range of outcomes narrows. Does this mean the rest of 2023 will be a straight line up in the markets? No. And while forward volatility positioning and vol curves are arguing for a strong May and early June, which we laid out last December in our first half 2023 forecast, they also portend to a very normal late summer sell-off. And I'm going to close this podcast by showing you a chart of daily realized volatility. This is what the markets are actually doing. It's not what you feel when you watch TV or your screens or what the option traders are pricing in. This is actually the math behind market volatility that is happening right now. As you'll see, market volatility rose throughout 2022 into June of last year as inflation was ramping higher and the Fed accelerated their hawkish rhetoric. However, since June of 2022, the trend in realized market volatility has been down. Not flat or up, as many on TV would lead you to believe, but down and to the right, lower highs and lower lows. We are now quickly approaching realized volatility levels that existed pre-market sell-off in 2022 and pre-Fed interest rate increases. If you want a reason why your portfolio is likely recovering when the newsletter writers and TV anchors are pitching fear and market collapses, look no further than this chart. Realized volatility has been declining, and viewers, that is bullish for your stocks. Investors, when talking heads on TV start talking about volatility in the markets and your emotions and anxiety get juiced up in a negative way, try as much as you can to walk away and take a deep breath. When it comes to asset allocation changes, most of the time, the best action is no action, particularly during times of high volatility. The best time to make changes in your asset allocation is when your emotions are low and market volatility is low as well. Investors, there is no perfect investment philosophy, and there is no perfect market trading tool that's all-weather, outperforming every stock cycle or every economic environment. At Oak Harvest, we have many tools that our advisors use to help our client meet their retirement goals and objectives. These tools are both market-based and insurance-based. The future in the stock markets is always uncertain, and that's why our retirement planning teams plan for your retirement needs first and your greed second. Give us a call to speak to an advisor and let us help you craft a financial plan that helps you meet your retirement goals. Call us here at 877-896-0040 and schedule an advisor consultation. We're here to help you on your financial journey into and through your retirement years. From the whole team here at Oak Harvest, have a blessed weekend.